Yeah, I'm Daniel.
And I'm here.
So imagine waking up to a global market that is just, bathed in red.
Right, like totally bleeding out. You look at your screens and you see energy shocks out of the Middle East, military strikes in Eastern Europe.
And a highly hawkish Federal Reserve flashing these massive warning signs. I mean, usually that setup writes its own predictable narrative.
Oh yeah, you expect an absolute bloodbath.
Exactly. You expect panic selling right out of the gate. But if you stepped into the actual trading day we had today, Monday, July 6th, that predictable narrative was completely shattered.
It really was. We are looking at a market landscape today that gave everyone absolute whiplash.
Major U.S. equity indices basically staged this massive intraday rescue. They shook off some incredibly deep early losses to finish right near the session highs.
Yeah, just to put some numbers on that, the NASDAQ 100 swung from an intraday low of 29,522 to close all the way up at 29,942.
Unbelievable.
And the S&P 500 mirrored that resilience, recovering from its own dip to close at 7,596.
So it was a textbook definition of dip buying, but it happened against a backdrop that makes that buying pressure genuinely baffling on the surface.
Totally baffling. So for you listening, here's the mission for this deep dive today. We're going to unpack the underlying mechanics driving this massive market whiplash.
Right. We'll explore how stubborn services, inflation, and a rigid Federal Reserve are just, colliding with official U.S. Treasury warnings about an AI bubble.
And on top of that, we have massive corporate workforce shifts, a brewing retail price war, and then we will close out with our daily paper trading segment.
The goal here is really just to help you understand the actual baseline you are operating against, moving past that surface level panic.
Absolutely.
And just a quick but really important note before we plunge into the mechanics. This deep dive is strictly for market context and discussion.
Right. We are here to analyze the data and the macro forces, but this is not personal investment advice or a recommendation to buy or sell anything in your own portfolio.
That's a crucial distinction. We're simply examining the plumbing of the market to see where the pressure is building.
Exactly.
All right, so session one. What set the stage before the U.S. session? Because the global macroeconomic board was shifting aggressively before the opening bell even rang in New York.
Yeah, the energy sector threw a massive curveball early this morning.
It did. Well before sunrise on the East Coast, the first major shockwave hit.
Right. Saudi Arabia's state oil giant, Aramco, announced they were slashing their August Arab Light official selling price to Asia.
By how much?
By a staggering $11 a barrel. It hit the tape at 5:12 a.m. Eastern Time.
$11. Wow.
Yeah. To put that into historical context, we are looking at their biggest single price cut since at least the year 2000.
But I mean, you can't view that pricing move in a vacuum, right? You have to pair it with the physical supply data that was crossing the wire simultaneously.
Exactly. We saw reports confirming that UAE crude production jumped above 3.8 million barrels per day in June.
Which is their second highest level on record, I believe.
Yes. And throw in the background news from over the weekend that OPEC Plus agreed in principle to boost their overall output quotas starting in August.
So you're suddenly looking at a massive coordinated supply-side expansion. I want to pause on that because for the U.S. consumer and for equities broadly, this is an incredibly powerful tailwind.
It is.
We frequently use the shorthand of falling oil prices as a consumer tax cut. When you have this much physical crude being dumped onto the global market, it drives prices down.
Right. WTI crude was trading essentially flat around $68.63 today.
And that directly pulls down headline inflationary pressures.
Right.
It means it costs less to fill up the gas tank, which leaves more discretionary income in the pockets of consumers.
It's essentially a giant relief valve for the broader economy.
It is.
I agree with the logic of the relief valve, but what makes this specific morning fascinating is the severe tension between that physical supply glut and the geopolitical reality.
Oh, for sure.
Because just an hour before that Saudi price cut hit the tape, at 4:08 a.m. Eastern Time, we saw breaking headlines that Ukraine's military had directly struck Russia's Omsk oil refinery overnight.
And this is where I have to play the skeptic, because the market reaction just doesn't align with history.
How so?
Well, you see a headline about a direct military strike on a massive piece of sovereign oil infrastructure. Usually the algorithmic reflex is to immediately price in supply destruction.
Right, and oil spikes violently.
Exactly. So why on earth didn't oil spike today? Why did Brent crude just sit there, remaining totally range-bound around $72.01?
Because you have to stop looking at these geopolitical events as unpredictable natural disasters. The market is getting much smarter about this.
So what's the framework here?
It requires looking at the situation through the lens of geopolitical choke points as bargaining leverage.
Okay, right.
The institutional money is increasingly viewing these strikes on energy infrastructure not as like isolated, uncontained catastrophes, but as highly calculated leverage plays.
Right. Keep in mind the background news from this past weekend regarding a very intense diplomatic push to settle the conflict, which included scheduled bilateral talks.
Exactly. The market is essentially pricing in the probability that these military strikes are about maximizing a negotiating position ahead of those expected diplomatic talks.
Ah, I see.
When you layer that calculated game theoretic view over the overwhelming physical supply flooding in from OPEC Plus and the UAE, the geopolitical risk premium in the oil market just gets completely overpowered.
Overpowered by the physical glut. Okay, so the oil market was essentially screaming that supply is abundant and geopolitical fears are overblown.
Yeah, that sets a very specific, almost comforting tone.
But while that relief valve was opening in the Middle East, we had a massive structural shift happening in Europe that threatened to just drain liquidity globally.
Yes. Right as Europe was fully waking up at 6:59 a.m. Eastern Time, Germany announced a truly historic policy shift.
This was wild.
They are officially initiating an 800 billion euro borrowing program specifically earmarked for military rearmament.
I mean, that is a staggering amount of new debt issuance.
It is. It's projected to push Germany's debt-to-GDP ratio all the way up to 69.5% by 2027.
I want to break this down for the listener because it's easy to hear, German military budget and assume it has nothing to do with a U.S. tech portfolio.
Right. People tune it out.
Exactly. But why should an investor in New York or Silicon Valley care about German sovereign debt?
Well, it all comes down to the plumbing of the global bond market.
Okay.
When a massive, fundamentally sound economy like Germany decides to flood the market with 800 billion euros in new sovereign debt, they need buyers to absorb all of those newly issued bonds.
And to attract those buyers, the yield on that debt has to go up.
Yes. Because global capital is fluid, that creates a vacuum effect. Upward pressure is placed on global bond yields across the board, including U.S. Treasuries.
So it effectively crowds out private investment.
Exactly. Capital naturally flows toward the higher-yielding government-backed debt, which raises the risk-free rate globally.
And when the risk-free rate goes up, we know that severely restricts the valuation environment for equities.
It does.
So before the U.S. cash session even opened, you had this incredibly complex tug of war. A massive energy supply glut providing inflationary relief on one hand.
And a massive European debt expansion acting as a giant vacuum on global liquidity on the other.
All right, so that's the setup. Let's take a quick break, and when we come back, we'll dive into how all of this collided with the U.S. Open.
Stick around.
And we're back. So session 2. What moved markets during U.S. trading hours?
Well, the moment the opening bell rang in New York, that relief from the oil market ran face first into a domestic brick wall of economic data.
Oh man, the economic data drop this morning was a heavy one.
It really was.
Shortly after the open at 9:45 a.m. Eastern Time, we got the ISM Services PMI. Now, the headline number printed at a solid 54.0.
Which tells us the U.S. services sector is still firmly in expansion territory.
Right, people are still spending money on experiences, travel, dining. But if you look under the hood of that report, it gets really troubling for the market.
Yeah, the prices paid component.
Exactly. The prices paid component of that index, which measures the cost of inputs for these service businesses, was stubbornly sticky, printing at 67.7.
And that sticky inflation data directly collided with the commentary we were getting from the Federal Reserve throughout the morning.
Starting right around 8 a.m. Eastern Time, right?
Yes. Fed Governor Christopher Waller was making public comments, and he was issuing some very stark, hawkish warnings.
What did he say, specifically?
He explicitly noted that while the labor market has stabilized, inflation in the services sector is, to use his exact words, taking off.
Wow, taking off.
And perhaps more importantly for the bond market, he firmly stated that the Fed will not artificially suppress interest rates simply to help the U.S. government finance its own fiscal deficits.
So he was signaling a rigid, uncompromising commitment to price stability, completely regardless of the borrowing environment. Which brings us right back to the framework we often discuss. Discount rates as valuation gravity.
Right.
When you have the Fed explicitly signaling a higher for longer rate environment, and you have sticky services inflation proving that their job isn't done, that valuation gravity gets significantly heavier.
Yeah, we saw the 10-year Treasury yield push up near 4.479% today.
Normally, that kind of yield environment paired with a Fed governor essentially saying, we don't care about your deficits, we care about inflation, would absolutely crush high multiple tech and growth stocks.
And that gravity was compounded by an institutional red flag waving right before the market opened.
The Treasury report.
Yeah, at 7:57 a.m. Eastern Time, a draft report from the U.S. Treasury hit the wire, citing the Bank for International Settlements annual report.
And they formally warned of severe financial stability risks stemming from an AI bubble.
Yes, and they weren't just vaguely warning about valuations. They specifically cited the systemic risks of leveraged financing and massive overinvestment in AI infrastructure.
I want to pull on that thread because this is where the mechanics of a bubble actually matter. What does the Treasury mean by leveraged financing in this context?
Well, they are pointing to the fact that the hundreds of billions of dollars being poured into AI data centers, specialized GPUs, and power grids aren't just being funded by cash on hand.
Right.
Companies are borrowing heavily to finance this capital expenditure supercycle.
Taking on massive debt at high interest rates.
Exactly, and making the assumption that future AI software revenues will easily cover the debt service.
So the Treasury is warning that if those AI models do not generate the exponential cash flows everyone expects, you suddenly have billions in bad loans sitting on bank balance sheets.
The overinvestment stops being a tech sector problem and becomes a banking sector problem.
Okay, so this is where I have to push back incredibly hard on what happened today.
Let's hear it.
We have the U.S. Treasury formally waving a red flag about a $700 billion capex supercycle, warning of a potential bust driven by leverage. We have the 10-year yield near 4.5%. We have the Fed saying inflation is taking off. How on earth did the NASDAQ manage to ignore all of that gravity and rally 400 points off its intraday lows?
I mean, it is the defining cognitive dissonance in the market right now.
It makes no sense.
The most mechanical explanation is that buyers simply could not resist the technical levels of the dip. We know that sector rotation suppresses volatility.
Very true, yeah.
Capital that was hiding in defensive sectors suddenly saw tech valuations momentarily compressed and rushed back in for an entry point.
Okay, but we have to be clear-eyed here. Just because the market rallied today does not mean the structural risk has vanished.
Not at all.
The tension between heavy tech capex, the regulatory scrutiny building in Washington, and the fact that AI capex hits physical power limits.
That narrative is completely unresolved.
Right. The market essentially put its hands over its ears and bought the dip today, but the Treasury's warning is still sitting right there on the table.
The gravity is still there, even if the market decided it could jump a little higher today.
All right, let's take one more quick break. Coming up, we'll look at the specific companies that drove today's action.
Be right back.
Okay, we are back. Session 3. What were the key corporate events today, and what should we watch next?
Well, because the macro data was heady today, the corporate tape was incredibly revealing. Let's look at the tech megacaps, starting with Microsoft.
Right.
Before U.S. trading hours even began, at 6:31 a.m. Eastern Time, Microsoft made a highly significant announcement.
The job cuts.
Yes. They are cutting 6,400 jobs, which represents roughly 2.8% of their global workforce.
And these cuts are primarily targeted at their traditional sales divisions and their Xbox gaming unit.
Exactly. But what is crucial here is the PR spin. Microsoft went out of their way to explicitly state that these roles are not being replaced by AI.
See, I look at that explicit denial, and it raises a massive structural question for me.
What's that?
Microsoft is pouring tens of billions of dollars into AI infrastructure. They are building data centers as fast as they can secure land and power.
Right.
At the exact same time, they are quietly shedding thousands of jobs in their legacy divisions.
So you're saying they're related?
Even if they promise the public that it isn't an AI algorithm directly replacing a sales rep, you have to wonder if this is the beginning of the AI infrastructure cost reality setting in.
I see.
The capital intensity of the AI build-out is so staggering. Are we seeing companies forced to find aggressive fiscal discipline in their traditional business lines just to afford the power bills for their data centers.
Is a very valid thesis, especially when you overlay it with the Treasury's warning about overinvestment.
Exactly.
But the market also received some highly reassuring news on the hardware side of the tech trade, which fueled that intraday rally.
The Broadcom and Apple news.
Right. At 5:02 a.m. Eastern Time, Broadcom and Apple announced they are extending their custom ASIC silicon collaboration all the way through 2031.
Which cements long-term predictable supply chain stability for both of those megacaps.
Yes.
And building on that exact theme of hardware demand, we saw Micron disclose a strategic supply agreement with Ford at 3:01 a.m. Eastern Time.
Right. And this comes right on the heels of Micron's massive $41.46 billion third-quarter revenue print.
I find the Ford deal particularly illuminating. To me, it proves that the demand for high-bandwidth memory is no longer just a niche story about hyperscale data centers.
Yeah, modern vehicles are essentially rolling server racks now.
Exactly. High-bandwidth memory is a structural requirement across legacy industries, including automotive advanced driver assistance systems.
That is the bull case for semiconductors right now. The demand base is broadening far beyond just large language models.
But while tech hardware was flexing its pricing power, the retail sector got hit with a political and competitive bombshell that threatens to destroy pricing power entirely.
Oh, the White House event.
Yes. Starting around 9:29 a.m. Eastern Time, President Trump held a White House event. He spent some time praising tech firms like Dell and Micron for their domestic investments.
But the real market mover was his announcement regarding Walmart.
Right. He publicly stated that Walmart is aggressively cutting prices, specifically highlighting a 15% drop on ground beef.
And he used the platform to urge all other major retailers to follow Walmart's deflationary lead. That news really permeated the market later in the day, around 4:46 p.m. ET.
This is an incredible dynamic to watch play out. On a macroeconomic level, a 15% drop in the price of ground beef at the nation's largest retailer is fantastic news for the consumer.
Definitely. It is a direct weapon against that sticky services inflation we saw in the ISM report.
But for an equity investor, it's like setting off a deflationary grenade in the retail sector.
Totally.
The consumer gets to catch the shrapnel in the form of grocery savings, but it is going to completely blow up the profit margins of the competing stores standing next to Walmart.
Yeah, you cannot slash retail prices by 15% without someone's profit margins taking a catastrophic hit.
And Walmart has the supply chain scale to absorb it, while their competitors simply do not.
The market fully digested that threat as the afternoon went on. It is a severe structural threat to margins in the broader consumer staples sector if a price war truly kicks off.
It really is. I mean, we had a day where the only thing recovering faster than a tech portfolio was the price of dinner.
Right.
Honestly, with Microsoft quietly shedding 6,000 jobs while swearing it isn't AI's fault, and the Treasury formally warning us all about an AI bubble,
If that bubble does actually pop, at least everyone can drown their sorrows in highly affordable backyard cheeseburgers.
exactly. Raise a spatula to the closing bell. The yields are high, but the beef is cheap.
I think everyone on Wall Street needed a cheap cheeseburger after the volatility we saw today.
We're kidding.
But looking ahead, we have to pivot our focus to the economic calendar. The main event you need to watch next is tomorrow morning, Tuesday, July 7th, at 8:30 a.m. Eastern Time.
Right, what's dropping?
We are getting the U.S.-made trade balance report. That data drop is going to be a key catalyst for the U.S. dollar and for cyclical stocks.
Especially given all the shifting dynamics we've discussed today regarding global supply chains and European debt.
Exactly. Keep a close eye on that 8:30 a.m. ET release tomorrow.